Welcome back to this series on investing. I've had a couple of questions about the series and why I'm doing it. So just to recap, look, I've had about 3 decades in the market, and much of it was learning via some pretty brutal reality. And that cost me a great deal of time and capital. I'm in a position now to help investors avoid some of that pain and learn what's important far more quickly. So that's the purpose of this series. Now, this particular video is going to cover a very important topic. In my view, far too much emphasis is placed on a number, a past performance number, like it's some sort of magic marker about the future. And a lot of people just seem to focus on that and nothing else. I'm going to explain how that number in isolation can be quite misleading, and most importantly, what an investor should be considering when they're evaluating a fund manager. So past performance has some merit, though there's no question about that. However, success in the market is about what's to come and not what has been. And that's one of the reasons that ASIC require the publication of a disclaimer around past performance, that past performance does not guarantee future performance. And yet I see so many people who are basically pinning their hopes based on past results. Past performance is just a number. It can be taken in context or it can be taken grossly out of context and therefore be misleading. Some of the things that you should think about, what contributed to the performance in that period. Was it a good time in the market? Was it a good time for the technique that particular fund manager used? Most importantly, is that process that was used to produce that result, is it repeatable? What were the risks that were taken to produce that performance? That's a key one that I find very few people pay much attention to. The particular fund may have generated a quite attractive return, but they may have taken risks to do so which are unacceptable to the investor. Are the conditions changing? Markets are evolving constantly. There are big picture rotations of capital from one sector of the market to the other. So are conditions changing? Have global markets reached a period where we may be heading into a bear market, for instance? There's no point in being heavily invested in good stocks if the overall market is going to go down for the next 6 to 12 months. And are the fund managers' techniques or the particular operational niche that they occupy appropriate for the next period? So these are all questions that will help you put that performance into context. Typical fund behaviour, we have funds that are what's called index tracking funds, and so they don't seek to add any value to the process of selection at all. They merely just track an index according to the market capitalisation. So by definition, that means that you get some good stocks, you get some ordinary stocks, and you get some downright terrible stocks. There are also fund managers who do stock selection, but they have an index mentality and they try and get results which are only slightly better than the index average. So they don't want to take too many risks because they might find themselves out of a job. So this sort of behavior, which is performed by many fund managers, basically guarantees mediocre outcomes. Now, if mediocre outcomes are good enough for you, then that's fine. Go with a traditional fund manager. But most people that I communicate with, a mediocre return is not what they're looking for. And it just makes sense that if you can zero in on a particular section of the market that's going to be more productive, as Warren Buffett has done throughout his 5 decades as an investor, then you've got a chance of getting a much better risk-adjusted return. A lot of the typical funds are structured in such a way that they have to inject more money near the top of the market and redeem money near the bottom of the market, because that's when investors put money in and take money out. So if you want to be part of the herd that has money going in at the top and being taken out at the bottom, then going into some index tracking or general funds will deliver you that return, and it won't be particularly spectacular. Some fund managers are unable to or are slow to react to the next crisis. Their mandate prevents them from doing certain things. But what happens to you if you're closer to retirement? Do you want to sit through the next GFC? Because there will be one at some point in the future. Now, fund managers also have a habit of following household names. And at the moment, we've got some great examples in Australia where the retail grocery industry, represented by Woolworths and Coles, are under attack from overseas organisations in their field, and are also under attack from Amazon as well. And yet many funds still will have a significant weighting towards the Woolworths and the Wesfarmers because of their market capitalisation, without actually thinking that the retail landscape is changing dramatically, and it's changing very quickly. So you've just got to be careful that you don't stay with what has been an accepted way of doing things if the environment is changing. And let's face it, the environment really is changing very quickly. Now, funds are increasingly turning to robo-advice as well, where a lot of information is injected into computer algorithms that spit out an answer. Now, I don't know whether that answer is good or not so good. I don't know whether it's being presented in the correct context. And that sort of bothers me. I don't want to hand over my retirement funds to a bunch of computer algorithms, which is increasingly the way that things are going. So these are just things for you to think about. Here's a useful perspective. The best performers for the previous year or two often do not repeat. And that's due to a couple of reasons. One can be that they just had good fortune in stock selection during that period, and so that may not repeat. And there are also cycles in the market where money moves into one sector for a period of time, we have a bear market in that sector, and then that sector recovers and goes into a new bull market. That shift is happening constantly, always has and always will. And if you look at a strategy which is called the dogs of the Dow, and basically what that does is it picks the 10 highest dividend stocks in the Dow from the previous year, which almost by definition means the 10 worst performing stocks in the Dow, and you hold them for the following year. And that strategy has been mathematically proven to outperform the Dow itself. So in other words, the 10 worst performers in 1 year tend to outperform the rest of the Dow Jones index in the following year. So just past performance does not necessarily guarantee that those 10 stocks are going to stay in that same lagging position. Fund managers may also leave a fund, because at the end of the day, a fund is about a core of one or two people who make the stock selections, and if they leave and go to another fund, then that fund may underperform. You need to avoid chasing short-term performance. So if you're using past performance as your only yardstick to where you're going to put your investment dollars, then it's often going to end in tears. So when it comes to past performance, what should an investor consider? These are the questions that you should be asking. Now, some of them aren't necessarily all that straightforward to get answers to, but these are things that you should try and investigate if you can. Has meaningful research been done to select just the best stocks? Or is it just, as I said earlier, a bit of same old, same old? Does the fund manager consider the bigger picture context of what's going on around the world? There is no point in being heavily invested in a market that's topping out and may go down for an extended period of time. So there's always a bigger picture context. You can't just look at stock selection and be heavily invested most of the time, not if you want above average results. Does the fund manager fully understand the practical dynamics of the market? markets are changing rapidly these days. We've got computer algorithms that are changing the nature and the dynamics of the market, and you really need to understand those practicalities to be able to get the best outcome. Theory of how market works often breaks down, and more so these days than ever before. Does the fund mandate allow sufficient nimbleness in the way that the fund is operated? Some funds are just so big that it's like turning around a really, really big ship. You just can't do it quickly. And markets can move from one level of sentiment to another very, very quickly these days, far more so than in the past. Is the fund manager flexible to changing conditions, or are they locked into their own little prism where they tend to look more over their shoulder than out of the front windscreen? So they're all questions that I think you should ask. Just consider the recent situation we've had with GDXJ, which is the world's largest index for junior gold miners. Now, they became a victim of their own success. Money flowed into this ETF as a means of getting access to junior gold stocks, and it flowed in at such a dramatic pace. And the fund manager, of course, then had to go out and buy the underlying shares that were part of their mandate. And they got so big so quickly that they became a victim of their own success, because they were starting to run up against regulatory limits where they would have to make takeover offers for certain companies. And so as a consequence, that disrupted the operation of GDXJ. They had to sell down some stocks, not because they wanted to or because they were poor value or they represented a risk. They just had to sell them down because of some practicalities of their mandate. A real concern for some ETFs in the future will be liquidity and structural issues, and some ETFs are going to blow up. There are over 3,000 ETFs just in America alone. Many of them are quite illiquid and have some significant structural issues, and it's almost inevitable that at some point in the future, some of these more at-risk ones will blow up. So my overwhelming advice is to stay with the ETFs that reflect large and highly liquid stocks. And the ETFs that I tend to focus on have turnovers of tens of billions of dollars in a single session. The turnover is just absolutely massive. So they're the sort of ETFs that you should be looking at. So to wrap it up, a sensible approach from my perspective is, yes, consider past performance. I'm not saying it's not relevant or it shouldn't be looked at all. Consider it, but study how the fund manager is positioned for the next period. Is the way that they intend to operate appropriate for the next period? Do they have the flexibility to adapt to changing market conditions? And if you can't make that determination, then just try and understand a little bit about the fund manager's methodology. And ask yourself, does it pass the feel right test? I always find that, no matter what level of knowledge or experience you've got in the market, you can always ask yourself the question whether it's logical, whether it feels right. If you were trying to find the best investments personally, what would you do? You don't have to be a finance professional. Just look around you. What are people buying and what are they doing? There's a famous fund manager, Peter Lynch, that always said, if you want to find good investments, then just go out and go to the shopping malls and just look at what people are buying, and that's where you'll find some of the best investment ideas. Is your fund manager in step with demographic change? We've got some amazing changes going on around the world that are going to propel certain sectors to great heights, and at the same time are going to drag other sectors down that are becoming obsolete. So is your fund manager in step with those demographic changes, or are they just doing the same old? Because that's not the sort of fund manager that you want. And that, of course, leads to the question, will their past performance become irrelevant? A fund manager that's had a heavy weighting to the Australian retail sector and to the banks in the last 5 years has probably done pretty well. But I can tell you that both those sectors, in particular the Australian retail and grocery sector are under great attack, and that if the fund manager sticks to that sort of balance in the portfolio, then they're almost certain to underperform in the next period compared to some of the new economy stocks. So that's the subject that I think is of great importance. I'm just trying to open your mind up to ask smarter questions about past performance. So what's coming up next is using options to generate relatively low risk income. Most people are turned off when you mention the word options, but there are certainly things that you can do that can produce above average returns for certainly for risks that are lower than just purely owning the stock. I'll be covering the basic principles and particularly around covered calls. What are they? What sort of return can you expect? What are the risks involved with covered calls, and how best to exploit them? It's a very important skill to develop. So even though you may be confused by options or know nothing about options, I would really encourage you to pay attention to that next video. If you have any questions, here's my contact details, and I'll be back with you shortly with that video on covered calls. Cheers.